Hey everyone, welcome to The Biggest Talk. For those of you who don't know, we break down some of the most influential bestsellers of our generation and read them so you don't have to. Now today, I won't be joined with my guests, Ira and Harrison, because, at this point in time, everybody's busy with finals and just the winter season is very busy for everyone, but I got to keep the podcast alive. So today, we'll be going over Tony Robinson's Unshakable. Now, this is a very information-dense book. And since I don't have the other two, this is not going to be so much about our perspective and our thoughts on it, just really giving you the facts because I feel like they're very beneficial for me. And as you can see, all my little tabs, I have a ton of notes because, a lot of it's just facts that I want to remember because it'll help me in the long run. So the book is divided into 3 parts. So for this first part, it's called Wealth, the Rule Book. It's pretty much laying down all the facts of the market, right? This is all about investing and really being in control of your money. So a few of the main facts in the first chapter is that understanding that the market dips 10% or more every year on average, 10% or more. And that's called a correction. 10% or more, but not more than 20% is called a correction, which happens every year on average. And understanding this dip will make you a lot less fearful when, being in the market, right? You get in at a higher point. Let's say it dips and you're really fearful because you're losing money, but you have to understand that the market is always going up. If you look at a 20-year chart, you see it go up and then 2008 it dips, but then it goes up, all the way, right? Even with little dips in between, the overall trend is an upward pattern. And so understanding that it's always going to be a winning bet in the long term. Another fact is the market as a whole returns 8 to 10% a year on average, right? So another very beneficial thing to know is that it'll dip 10% or more a year on average, but it ultimately over the year grows 8 to 10%. And then also understanding what you're chasing, right? It's just do you really just want money or are you chasing the emotions of it? Just really understanding what you want, how you want to execute it, and if you really just are in it for the money or because the main part of this book is to take control of your money and do great things with it. It's not to be, a bigger asshole or D-bag, right? Getting a new BMW. I mean, you could spend your money on whatever you want, but ultimately it's for giving you that comfort in life, knowing that you're not going to be screwed over when you're 70 and you want to retire. So a terminology to know is the bear market is a drop of 20% or more. And this happens every 3 to 5 years on average. So there is going to be a dip of 20% or more every 3 to 5 years. So this is a reoccurrence. Understanding this will probably relieve some of that stress and anxiety when the market is doing so poorly, because understanding that it will eventually, correct itself and go back up, that you're not really going to lose that much money unless you get out when you're fearful. And he later talks about winter is coming, but when? We refer to these dips and all this, like the times of, of a bad economy as winter, because it comes and it goes. It always goes. Every bear market has been followed by a bull market. So every drop of 20% or more has been followed by a gain of 20% or more, which is, very beneficial to know, I feel. And a few quotes because he speaks with 50 of the wealthiest investors in history to gain all their knowledge and condense it in a book for us. Some quotes is, the best opportunities come in times of maximum pessimism. And it's so true, because when everybody's so afraid that, they're going to lose all their money and everything, everybody sells. And then you get to this low point where it's like buying an iPhone. It's like buying an iPhone for like $50, right? The new iPhone is on sale for $50. So of course you're going to pour all your money into like 10,000 iPhones. And then when it goes back to normal price, you could just sell them all. That's what happens when there's these bear markets. Is pretty much like that example, is that it's like things go on sale. So why wouldn't you buy it? Another quote that I really liked was, the stock market is a device for transferring money from the impatient to the patient. It's not a short-term game. Like we said, it returns 8 to 10% a year, but if you got to, it also dips 10% a year. So if you're in it for the short term, a couple months, you could very be one of those people that loses money, and a majority of people do. And then from here, we kind of take a detour to fees and how a lot these fees really eat away at your investments. And you think, oh, I'm doing it right. I'm in the market for a long term now. Let's go. But it really depends on what you're investing in, what company, who's taking care of you. And this is really, really important, because it has to be somebody you really trust, that because it's your money, it's your retirement, it's your long-term money that you expect to grow. And there's this myth that people really think that they could beat the market, but you can't. And these ideas that you can beat the market incentivizes poor trading, which is like them playing with your money and allocating it in different places. And a lot of big companies and corporations, they take your money and then they play with it. They put you in certain stocks, take you out, put you in all these different things, and those things take money. It takes commissions to keep moving around your money. And the fees that they charge for even having your money, right? They take like 20% of your profits or 2%, all these different fees. There's so many fees that he goes through, but I'm just going to lay it out as there's a lot of fees, and you really have to watch out for them, that realizing that there's going to be some people out there that will have a better, your interest more at heart than some of these companies, regardless if you think you're doing it right or not. So a main thing he talks about is index funds. And what these are pretty much like following like things like the S&P 500 with very minimal fees, because they're not playing around with your money. They're not pulling you in and out of stocks. You're just pretty much in a position where you're following the market as a whole, because like we said, the market overall trends up. In the long term, it trends up. So it's a winning bet. So this invests in that bet that the market's going to go up. You're betting on the market going up. And like we said, 8 to 10% a year, that's pretty great. A lot of big corporations fail to even hit that number, which is ridiculous, because the whole point of you going to someone instead of just putting your money in an index is you expect them to outperform the market. But I think he says something like 4% of corporations or companies actually do beat the market, and you don't want to take that risk, right? 4%, that's incredibly low. But so he explains indexing to be the best way to grow your money, because 8 to 10% a year compounding it does incredible things to your account. And then he goes into 401ks and how 71% of people with 401ks think there are no fees, and 92% don't know what the fees are. Now, this is incredible, because it's just kind of, I think just because it became so normal, it's such a staple thing. Everybody has a 401k. Like all my parents, all they talk about is their 401k. And it seems to be doing well for my family. I don't know how it works completely, but there are a lot of fees that go along with that, and there could be a lot more growth if you understood, like if you put your money in the right places. Sorry. And the next chapter is about rescuing your retirement plans. There are a lot of fees that eat so much of your profits. It's actually incredible. He goes into some examples about like how much money you would have if they didn't have these crazy fees, and in situations where what the fees actually do to you in the long term. And the difference is crazy, but I don't really have the example on here. So he promotes this business called America's Best 401k, because they charge 0.65 in fees a year, which is incredibly low. A lot of the other examples he gives charge 3-4%, 3-4% every year annually. The market grows 8 to 10. If it grows 8, they take half of the profits, which compounding will turn into a lot more, right? He gives the example, every $1 you have would turn to 30, but if you let these fees eat away to you, every $1 turns to 10 in the long term. And that's ridiculous, right? Because 1 to 10 is great, but over, 50 years, you kind of expect, your money to duplicate. But imagine 1 to 30, right? It's eating away 2/3 of your profit. So you really have to be aware of what you're getting into. So who can you really trust? There are 3 types of advisors that he mentions. And the first one is brokers, right? They get paid to sell you expensive products. And that's pretty much it. Understanding if you're working with the broker is very important, because they're really in it for themselves. And the next one is independent advisors. These people are forced to have your best interest in mind. It's by law. And they must disclose how he or she is paid, and they can't accept commissions. And this is only 10% of financial advisors, because honestly, brokers just get paid a lot more. And being an advisor, you really have to have someone else's best interest in, and that's not really great for you. And then the last one is dually registered advisors, and these are people who are registered as brokers and independent advisors. So it's very deceitful, because they can by law they say they have your best interest at heart, and then they can go and sell you expensive products because you believe that they have your best interest at heart, because they're double registered, right? They could just turn on you the next day. So these people in total, right? In total, there are about 5,000 or 1.6 of financial advisors are independent advisors, people that actually have your best interests at heart. 1.6%. So finding an advisor is very important, right? As long as you can, finding that 1.6% is going to be very hard, right? 5,000 out of who knows how many people. But if you can at least put yourself in a position where you're a little more educated and can, play your cards a little bit more properly, that's great. You can get in just a better position than you are today. Regardless, if you can't find that 1.6% is kind of my point. And even after eliminating 98% of advisors, it's still possible for independent advisors to take advantage of you. And there's 3 things he says to watch out for when choosing an advisor. And making sure that they don't have sister companies that sell like mutual funds to their advisors to promote the funds, right? And then the second thing is additional fees for doing nothing. Like they could charge money management fees. Like these things, they title these fees. So you're kind of like, oh, okay, that makes sense. But they really are irrelevant. And like things like consulting fees, like where they make private deals with firms to earn commissions. And it's incredible how people will always try and take advantage of you. And it's so hard, right? Because you're putting your money, this is, your lifeline, into someone else's hands. And you got to be very selective when doing this. Take the time to actually find the right person, because I think it'll make the world of a difference. And there's 5 criteria that he talks about when selecting an advisor. First one is check credentials. You should make sure that they're certified and everything. They should be more than just getting you an investment strategy, because it's an advisor. This was to be there for your needs. And that's the next one. Experience for your needs. And the next one is you and your advisor should be aligned. This meaning, like, do they think they could beat the market? Because we obviously realize that that's not true through reading this book. And lastly, relate on a personal level. You have to be comfortable with this person, because you have to trust them, and they're going to handle, your financial future. So it's pretty important. And lastly, some extra criteria for your advisors. So there's a lot of criteria you got to go through. I mean, obviously you can't hit every single one. I mean, if you could, that's amazing. You probably found that 1.6%, but it's not likely that you could find, the so few that are great. And usually the ones that are really amazing have a high, premium to work with them. So some extra criteria. If they're affiliated with any broker deals, do the firm offer mutual funds or separately managed accounts? Do you receive any third-party commissions recommending investments? Just all these questions. He lists a bunch of questions that you can ask your financial advisor that they legally have to answer, so you can really understand where they're at. And this is pretty much sums up the first part of the 3-part book. So mainly understanding, this is really just facts, right? This part is called Wealth, the Rule Book. These are undeniable facts that have happening in the market, right? 10% correction every year, 10% or more. And then 8 to 10% return every year, right? And bear markets happen every 3 to 5 years. Understanding these things, that winter is coming and that there's a lot of fees that go into what you think is the right investment, and just being knowledgeable about these things to move forward is going to be very beneficial for you, because you'll be a lot more skeptical, and in a good way, right? Because you really want to put your money with someone that is reliable and that you're in the right spot. So he really kind of gives the secret in this section too, that index funds are the way to go, because that's betting on the market. And as history shows, the market is a winning bet. So overall, that there's a lot of information here that I hope you guys can retain. They're very simple ideas, but they're very beneficial to know. And in the next part, it's called the Unshakable Playbook, which really goes into, diversifying and where to put your money. And I hope you guys are ready for that, because that's, taking action. Other than that, that's been the first part of this book, and I hope you guys enjoyed. Let's go out and get this bread.